Welcome to The Lumber Word, where industry veterans Matt Beamer, Gregg Riley, and Ashley Buckholt dissect the world of commodity lumber each week. We bring you up-to-date insights on supply, demand, and market trends, sharing our trading expertise to benefit everyone in the supply chain. Join us for informative and entertaining discussions that guarantee to make you wiser about all things lumber.
Well, we'll kick it in while everybody's getting set up here. Everybody, welcome to episode 105 of the Lumber Word, January 15th, 2025. Wanted to give a couple shout outs before we get into this fun lumber market, confusing lumber market. Shout out to Eric Wilderson. Eric, I hope I got your name right, from Eagle Forest Products out in Idaho. He listened to our show last week, and Gregg mentioned the 2x4 12 and 14 we had down in Port Arthur, and their truck is pulling out right now with that stuff on it. So Eric, and just if anybody knows, Eagle Forest Products kind of manufactures lumber products at multiple locations and sales offices throughout the United States. Hardwood, softwood, cut stock, lumber, wood fencing, pallet manufacturers. So if you want to get a hold of them, it's eaglefp.net. Eric, thanks for listening to us, buddy.
I hope everybody understands it. I see how this works. You like look at the free marketing advertising you get. All you need to do is, buy a truck of lumber from us, and we'll do the marketing for you.
Can we just go straight into the
boys club at that point, Greg?
North America.
Let's just go right into the married, date, and dump, so I can just talk about all the stuff I want to dump.
Eric, I just want to also let you know the next one will cost you.
Yeah.
I was going to say my spots on this show aren't even that glorious.
And a shout out to
quiet time
to Justin Smith again from Tampa, who listens to us every day when he comes back from his bowling league at night.
Yeah. I just envision that bowling as it's like him and the dude, right? From Dumb and Dumber.
No, that's the dude from oh God, I can't think of it now. Somebody want to help me? Remember the dude?
It's probably some show that came out before I was born, so I don't have any.
Oh yeah, you're like a millennial.
Yeah, that's true.
Whoa.
Dustin, this is the best part of the show.
Yeah, of course it is. Yeah.
I know, Dustin, you got to chime in here, man.
Charles,
you got your crystal ball with you today, right?
I got kids older than you going to college.
So Ashley and I were talking the other day, and we're gonna try and do some things where we expand our horizons to other groups beyond our kind of insular lumber trading, forest products, housing group. We want to start talking about some more esoteric type things, so we can bring in other groups of people that might be interested. So Charles, maybe you can start us off and give us a little bit, tell us about how the cow tipping's going on down there.
We don't cow tip. Despite popular belief, we do a lot more than that in the South.
Charles had
somebody the other. Hold on, listen. I had somebody the other day. We were talking about wine, and he goes, "Yeah, not like the kind you make out of strawberries or watermelon like you do in the South." And I was like, "What? We have great wine down here too."
You had mold in your hay, didn't you?
Yeah, we did. We had a mold and a nitrate issue, but we solved it, so that's a positive.
Did it come from?
I heard. Can you tell us about how Mitch took care of that for you?
Whoa! I was the one that pinpointed that. He was supposed to be the doctor in the group, and he just threw his hands up and he's like, "I don't know. We got to figure it out." And I said, "Well, let's remove the only variable that we can control outside of the actual pasture." And the next thing you know, a day and a half later, we had them in a working pen, and they looked 180-degree difference. You want to talk about catching knives in a very interesting market? Check out that January feeders chart. That thing is rough if you're on the wrong side of it.
Are you in trading feeders now, Charles?
Yeah, we're doing everything we do is feeders.
I love that.
Yeah,
I love that.
Just so you guys know, that movie was The Big Lebowski.
There you go. Thank you, Ash.
Yeah.
There you go. Yeah.
And then Charles, you make sure with all those cows, you make Mitch check everyone with a rubber glove then, right? To make sure they're
Well,
all
it depends.
healthy
It
then.
depends.
I don't think you preg feeders, okay? Sorry. Ashley, that's not how it works.
No, I mean, we definitely preg check because, I mean, we buy anything from a 5 weight to an 8.5. So, I mean, we're preg checking a majority.
Yeah, look at that bull. Look at that bull market in feeders, huh?
It's crazy. Hey, and you know what's wild? So the managed money net managed position is at 26,384, which is the highest absolute max over the past 3-year trailing average.
They're long or short?
Net long.
Net long. Ooh. You know, just think of what the price of lumber would be if we got them over here that long, huh?
And the hogs are moving too. They're seasonally. They're moving. They're going against their seasonal move to the upside.
Question for Charles.
We're going to start talking about a lot of these other commodities. I think that's a good way to broaden our interest. Matt, do you want to talk about ethanol?
No, I want to ask a question of Charles. He's talking about feeders. I thought you were buying like yearling steers only.
No, we're buying bulls and steers. I mean, lightweight bulls, tournament steers.
You're not buying heifers though.
No, we are buying heifers.
Okay, that was the part that confused me because I thought feeders were just males.
No, I mean, feeders, stockers. Everybody's got a different way to describe them, but I mean,
I learned something new today.
It's basically like if you look at the contract spec, I think it's a 400, 900 pound animal.
Okay.
No matter the sex, but typically they're in straight truckload. Steers or heifers. So interestingly enough, I mean, Ash's buddies are the commodity pros. I'm just a lowly old guy from the South trying to diversify my exposure. That's all.
I like you're just going from one risky venture to another.
Well, how else are you going to feel alive, Matt? How else are you going to feel alive?
Next week, I'm going to see you on the X Games doing like triple Lundies off of the snow cone,
He's probably hedging them with Bitcoin or Farcoin.
I'm not. Actually, I did that the right way. Should
we try to rope this back in? And
yeah. Let's go.
Let's get into the lumber side. Reoccurring guest, Dustin Jalbert. I think I got that right that
you
time.
Nailed it.
Dustin,
French accent is really coming along, Ashley.
Economist with Fastmarkets, and Dustin, thought it was great to have you on always, but today especially. I saw you on X today talking to that one guy about where he said there may be a 7 handle on lumber if there could be a quote, and you were going back and forth with him. So there's been some great conversations, but let's start out. I looked at midweek last night. One thing I noticed, since I stay so spruce centric on a lot of things, and I got to open my horizon up and look at everything. OSB had a big sell off. And or continues to have one. U.S. species seem to still have some pressure to the downside. Pine was still relatively strong-ish, and spruce is all over the place with a bias to the upside with all the tariff conversation. I know Gregg and I were making a run through mills today, and it's hard to get anybody to quote you any volume out of the East. I heard some of the Western mills have at least started quoting loaded cars without tariff, but they're on a week-to-week basis. Gregg, what are you seeing on the Eastern side of the market and the Euro side since you're there?
I see 3 different sales approaches. Approach number 1 is, hey, we're going to add any Trump tariff if it's enacted on your car if you buy it. And option number 2 is, hey, we're only selling prompt loaders, so every day as cars come available, we put that out to the marketplace. And option 3 is, we're adding somewhere between $50 and $100, $1,000 to our previous U.S. price. And that's what our price is. Come and get me.
Matt, how about on the U.S. species? And you and I had a good conversation this week because I was trying to figure out what Coastal was trading into Chicago at. What are you seeing on 4-inch and 6-inch on all those coastal inland markets?
Well, not to pick on Dustin, but I think if you take midweek print and subtract about $20 or $30 on hem fur, that's probably more accurate. And then the inland side also, I've had inland mills calling me soliciting offers, and they're taking 40, 50 under print type stuff. I don't know if you can print it that way, but look, the trade is below what the published prices are. I'd say 2x4 is trading 540, 550 Chicago, 2x6 in that 660, 670 Chicago range. That's true for spruce also. So the hem fir and the spruce are really neck and neck. I lost some business to an inland mill, and I won't name names, yesterday into Colorado on some narrow lumber, which rarely happens because usually the coastal lumber just gets in there cheaper, right?
Yeah.
But somebody in the inland has too much inventory and had some empty cars and just decided to blow some stuff out. So there's things going on out here that don't really reflect strength. At the same time, our mills have order files, and we didn't play any games with like tariffs and all this stuff. Look, we're just in the cash market. We're making lumber all the time. We made it through the Christmas holidays fine. And, it's just business as usual around here. We're just competing with other entities that we have no control over, right? I would say that on the sales side, not the production side, but on the sales side, it seems like the appetite from Arizona and Texas in particular has kind of tapered off here in this week. Just there's still business out there, but not as much. And then, the Colorado, Utah has been decent. The West Coast, because of the fires and weather, hasn't been all that great, but we did sell a bunch of stuff into the Northwest local trucks yesterday. So on Doug fir business is pretty fluid, but I wouldn't call it a good market. We're like in a 4 or 5 or 6 range on a scale of 1 to 10 in terms of excitement. So
the reason I got excited about when I talked to you about, the new futures contract, you can deliver coastal hem fir. And you can deliver
nobody
dry
does it though, dude. Nobody wants to. I was actually talking to Rob Cross. That we had him on the show. He handles the futures for us and for me and many other people. And I said, Rob, what if they just take the Chicago contract and just turn it into a no delivery contract? He says, well, if they did that, I think it would fail.
In the fast-paced world of North American softwood lumber, staying ahead is everything. At Fastmarkets, we deliver cutting-edge analysis to keep you informed and prepared for the future. Introducing Fastmarkets Lumber Commentary, your gateway to understanding market shifts and price developments. Our short-term outlook offers a comprehensive monthly overview, packed with the latest trends and insightful analysis. From construction demand to housing supply side dynamics, we cover all the key indicators that matter to your business. Gain access to our renowned softwood lumber prices, including the industry-standard Random Lengths framing lumber composite price. Dive deep into essential market sectors like housing starts, repair and remodeling, and more with our expert analysis. But that's not all. Fastmarkets Lumber Commentary gives you the tools to anticipate market changes with detailed insights into demand and supply drivers across the US, Canada, and even offshore trade, and what this ultimately means for the pricing outlook for softwood lumber. Plus, you get direct access to the analysts behind these invaluable forecasts. Ready to make informed strategic decisions? Visit fastmarkets.com/lumber-sample and get your sample of the outlook today. That's fastmarkets.com/lumber-sample to get a sample and find out more.
Well, how about some U.S. inland mills actually deliver when there's a $40 premium?
I've done it. I've actually taken delivery before and gotten inland wood.
Yeah.
And, theoretically, Hampton could ship some 2x4 into the board. But, for some reason, mills have just sort of lost their appetite for shipping lumber into the board. They'd rather just treat it like a derivative or just ignore it completely.
Well, it's like, honestly, the best contracts have no deliveries at all. A properly functioning, efficient futures market, which is a price determining mechanism, ultimately has no deliveries. So that's a sign of a healthy market. The fact that there's a fairly decent amount of EFPs that get done, that's fine and that's great. And the more of that's the makings of a healthy futures market. So,
is there actually going to be a yellow pine market, Greg, or is this something that we just talk about on the show sometimes?
There should be. There is going
to be a Southern Yellow Pine contract. I'm going to try to get them on. I'm going to try to get the CME on if they can get on and talk about it over the next 2 to 3 weeks. That's going to happen sometime, I think, here. Hopefully in the first half of this year. So we'll we'll see on that one. But yeah, yeah.
Hold on, I got a question though.
Yeah.
You know, Matt also buys wood, right? Outside of just selling mill production. I mean, based on Gregg's description of the 3 sales approaches, which one are you seeing more predominantly? Because I think that's going to give you a underscoring undertone of what's going on, right?
Charles, who is that question to?
Matt.
Oh.
Can you kind of rephrase it? I'm not quite sure. I thought you were talking.
All right. So Gregg described 3 different sales approaches, right? And I know you buy open market wood in addition to selling mill production, right? Or your organization does, right?
Yep.
So out of those 3 sales approaches that Gregg described, which one are you seeing more predominantly? Which one are you seeing more of?
They've all abandoned the whole.
Is it a week to week?
Yeah.
Is it?
No, right now, for the most part in Canada, it's, people are dealing with prompt wood for the most part. That's what seems to be the primary focus is just, hey, we've got wood that'll ship before the 21st, because there's still a lot of unknowns, right? I don't know. I mean, I wish I had a magic wand and I could figure it out, or a crystal ball. But if you ask me to short the market for February shipment, I would just say, no, I'm not interested in doing that going into a new administration who's been talking about tariffs, Now, even though I said last week that I think that lumber's about number 347 on the list of things he's worried about, well, I just don't know. And when you don't know, best thing to do, fold your arms and just see what happens, right? So I'm not buying any lumber right now for a ways out, unless it's just firm price thing. I'm not taking any risk on the buy side that I'm going to have to eat a 20 or 25% tariff. Not interested in that. I mean, if it happens to all of us, then we'll all pay it, right?
Yeah.
If you knew there was going to be no tariff, what would your positioning be in the marketplace right now? Would you be bullish or bearish?
I'm personally bearish. I just think there's, mills are coming into the week of the 20th with a light order file. And I think the customers want a deal. So I'm in the short term, I'm bearish. In the long term, I'm bullish. I have information at my disposal that tells me things are going to get a hell of a lot better in March, April, May. And I know from my personal experience that things tend to get a hell of a lot better in March, April, May too. And I have no reason to not expect that again in 2025. But I think in the very short term, the next 2-3 weeks, I think mills have some issues, I mean, I'm not speaking for Hampton per se here. I'm speaking on all the phone calls I'm getting from other sawmills that want me to give them an offer or an order on stuff they have produced already, and they've got cars and trucks ready to go, right? So that's not even the Canadians. That's just American mills. So there you go.
Ash, is that a good segue to talk about the demand side with Dustin now?
Well, yeah, let's look for I want to first follow with
great having you, but I want to hear from you.
Yeah, no, I just want to real quick, Charles, Southern Pine, what's the market doing on that?
You tell me. I got no crystal ball. I mean, this thing is so scattered and nobody knows what to do, and everybody wants forward pricing and everybody wants this and that. And, guys are switching from spruce to pine because of some of the unknowns with tariffs, and there's just a lot unknown. Guys that need it are buying it, and typically the business we're transacting right now is, either in February, early March, or it's yesterday.
Well,
yesterday seems to be the volume of what's actually moving from point A to point B, and a lot of that has to do with everybody waited through the holiday season.
And forward pricing of an already undervalued item, to me, it's okay, they want you to basically speculatively short sell them.
But I don't know if I necessarily agree with that, because I mean, if you're talking about an undervalued item, what are you comparing that to?
I'm comparing to the only thing you can actually hedge with it, which is the CME right now.
Well, I mean, anybody that puts on
and I'm looking at an absolute value of where the price is too.
Okay, but if you look at it from a 24-month trailing average and based on all the things and single-family inventory the way it is and interest rates, there's a bet to be made. It just depends on how you're set up to whether you're going to be liquid enough to make it happen, right? Number one. Number two, what I've come to realize with people that arbitrarily set up a hedging program with a derivative of a derivative, right, pine for a spruce contract, and just leave it on and let it happen, they've absolutely gotten destroyed in the past.
Cross hedge hasn't worked very well, yeah.
I mean, no convergence, opposite ends of the spectrum, day and night. So there's really no way to hedge it unless you're set up and you have the ability to either put wood on the ground very inexpensively, or you have a way to back yourself up, which we have both of those.
So basically you hedge with cash on the ground.
Well, you can do that, and you can do some other things based on some negotiations and relationships that you have that allow you to facilitate that need at a cost benefit to that end user. But
so that's a great reason to have a CME contract.
When is Charles going to run for president? Holy cow! Listen to him talk. Damn.
You don't want me to run for president, I promise.
I do, man. Actually, you sound smart.
I'll jump in here real quick. Just one thing, talking about the hedging Southern Yellow Pine to spruce. We've looked at this, and the correlations between Southern Yellow Pine 2x4 and SPF 2x4 in kind of the let's call it the last year or two, 12 to 24 months. In some cases, we've been going negative, right? Usually we have a very high positive correlation, in the cash market between Southern Yellow Pine and SPF. Let's call that the pre-pandemic paradigm. Obviously, during the pandemic, correlations across the board went up, right? And then post-pandemic, pine has just completely decoupled from basically the rest of the market to the point where in some cases we're seeing negative correlations. So what Charles said makes total sense. Just to pull in the stats piece of it, it totally lines up with what we see statistically. So if you're trying to do hedging, you're going to be in a lot of trouble with pine.
Our historical R coefficient is 0.5 in that it's moves with it half the time and it moves against it half the time. So it's perfectly correlated that it doesn't correlate.
You know what Charles was talking about, though, in terms of not hedging it with the board, but hedging it with your relationships and your own cash and your own ability to store lumber. It reminds me back when I was a young trader, I used to go put these deals together for 6 months out with Willamette. Remember Willamette Industries?
Yeah, for sure.
We call it Wilmette, but yeah, go ahead.
Yeah. Well, I live here. Trust me, it's Willamette.
There you go again. Somebody making fun of my accent. It's fine.
Yeah.
I digress.
I live in Oregon, and it's the Willamette River. But yeah, no, Willamette I would bring them up and say, my guy in Detroit who wants to buy lumber for 6 months out, and here's what he's thinking, and here's the tally that he wants to do, and we'd have a dignified negotiation, and we'd all three parties would agree on a price, and we would just delay the shipment for a set period of time. It's no different than selling the board, except for I was just getting the mill to back the action. And you can do those kinds of deals if they actually make sense, right? But you have to have a relationship.
That'll do that today. There's pine mills that'll do that today. They'll sell you for Q2 right now.
Dude, there's fir and hemper mills that'll do that.
I wouldn't go that far. I mean, those guys are pretty strict on their quoting windows nowadays.
I'm not saying they're going to quote you today's cash price, but
I know they're not going to quote today's cash price. But the other thing is how do you calculate a premium if you're not doing it every day? If you're looking at it from a defensive position and you say I need to capture every $5 of appreciation, so I'm at X when the market's at Y, right? How do you say, okay, you're telling me that we need, and I'll just use arbitrary numbers, right? You're telling me you need to be at 100, but I'm at 125. But everybody, we know where the action is at 100 and nobody wants to be there. But then you ask them for a price forward and there's no way for that to correlate, right? Because they don't have anything to tie it to outside of historical norms and historical statistics, to Dustin's point. But the one thing that we do that a lot of people don't is really try to look at it from a different perspective. And I mean, that's really all I'm gonna say. And if you have the ability to put something together where everybody wins, that's the meat and potatoes of the whole deal. Because everybody wants to move volume. You just got to agree on a number. And what's that price premium or price risk worth?
So would you sell East Side Southern Yellow Pine 4-inch for the rest of the year at 500?
Heavy 12s, yeah.
Okay.
There you go.
FOB mill, yeah. All year. Heavy 12s, 2 or 3 14-16s. Yep.
Gotcha. Okay.
Well, I mean, you look at what interest rates have done. You look at what single-family home builders are doing. I mean, sooner or later.
So let's talk, Justin, tell us about, so demand side.
It's the Charles show. Y'all quit asking me questions.
Well, the reason
I know. I want Dustin
not
to come
me.
in
I
and give us
promise.
some stats on projected demand for next year. Let's get Dustin in here. We got him. Let's use him, man.
Well, I'm interested too because Dustin, I bet you're getting tons of calls and questions on the tariff and all that. Because Gregg and I yesterday, I finally was frustrated and I called him and make it, Gregg, I'm not selling anything today, and and guys are taking business below all over the East of what I thought. I mean, Charles, shit, somebody was selling like studs, 2x4 9-foot studs, $475 North Carolina yesterday. That's like one of the lowest.
Didn't they just rally last week and now they're already back down again?
So there's so much stuff happening out there right now.
Spruce at $475 in North Carolina.
Stud, yeah.
What?
No, it was the South Carolina.
South Carolina.
South Carolina.
Wow.
So but then you get a great order and there's such a disconnect. So Dustin, what are people asking? What are you seeing out there tariff wise and shit, just everything?
Yeah, there's just so many cross currents right now, guys. Right. And this is kind of piggybacking off of a little bit what Matt said here. I think if you kind of want to distill it down, kind of the rate environment is trumping, no pun intended, the tariff concerns, right? I think everyone's looking at a 10-year kind of pushing towards 5% and mortgage rates above 7%, right? And seeing that and saying, like, who cares if we get a 25% tariff? When you think about a commodity market, the price clears at wherever demand intersects supply, right? So, like, in the end, okay, if the industry's cost structure, for Canadians coming in goes up 25%, it's not necessarily going to be a 1-for-1 where that sort of reacts in the market environment for pricing, right? So I think everyone's looking at the demand side and things are not great right now, right? So we look at interest rates. I think there was a lot of, if you think about it from an expectations perspective, I think, and this is us included, I think our outlook is still that interest rates are going to cool later into the year as some of this policy uncertainty starts to shake out. But I mean, I think a lot of folks were thinking, once we got to 6% mortgage rates, it's like, okay, we're finally here. The market's going to start loosening up, and within a few months, we're back to 7%, right? So I think, that shattering of expectations of some loosening on the rate side is probably, driving a lot of the bearishness in the market. And I think it's warranted. I think the other thing right now, we're in the seasonal lulls right now. There's been a lot of weather out there. This is a time of year it's hard to gauge where the heck the market is at anyway, between, wildfires going on in California. You got abnormal cold in the South right now. I think it's a tough time of year to kind of gauge where things are going generally. But I would say, housing starts definitely in a depressed state right now, not seeing the kind of reacceleration that we'd want to see to be encouraged, stepping into the year here. The one thing I will say that I have, we have some level of optimism on, I think repair and remodeling is starting to show some subtle signs of kind of getting off the mat. Our repair and remodeling index, the RRI, is starting to slowly reaccelerate. Some of that could be due to weather. Bad weather tends to be good for the home center business. That tends to kind of boost their sales. How much is that is actually lumber is a whole other question. But I do think, there's some signs of momentum in repair and remodeling. And when you think about where the consumer is at, they've been kind of in this state of kind of cautiousness on really discretionary spending. I think some of that is going to subside post-election. Some of that, and also the underlying indicators that drive repair and remodeling, it's not just interest rates. When we look at real inflation-adjusted income, we're seeing that growing at a healthy rate. People are going to step back and do the remodeling at some point here. So that gives me reason to think that we are going to see some reacceleration. But, right now into the first half of the year, things don't look awesome right now, and I think pricing is reflecting that.
So, one of the things when I look at, I go, okay, we got housing starts come out on Friday, and we'll have final numbers for 2024. I mean, through 11 months, permits were down 2.1, which consisted of plus 8% on single family, 19.6 on multi. Starts were down 4.3, plus 7.2, and minus 28.9. So I go to 2025, and the mortgage rate argument I question, and here's the reason why. Right now, Lennar is offering 4.99% mortgages on their homes. D.R. Horton in selected markets is offering 3.5% mortgages on selected homes. So,
okay, go ahead. Yeah.
Yeah, no. Just, I'll finish this, and I want you to come in. So, like, I go. So, okay. So, what's my projection for 2025 on single family? It's dominated by the major builders that can buy down. Okay, higher mortgage rates more have an impact on existing homes than on new homes, and which is why we've seen that collapse of price. That new homes now are the same price or less than the existing homes in the market.
Yeah,
go ahead.
I would say generally, we still think housing starts will be positive this year for some of the reasons you've described, right? I think when you think about the easiest, the path of least resistance in terms of affordability for buying a house, it's still the new side because of the big builders are building smaller. They're building what the market needs, right? As opposed to the resale market, which is what it is, right? It's probably too many big homes. They haven't adjusted on price. I think what does concern us, though, you mentioned the rate buy downs, right? Those rate buy downs are not through the duration of the mortgage most of the time. It's usually a 3-2-1. So it's kind of a teaser rate. First year, it's 3.5. Second year is 4.5. Third year, you rack up to the prevailing market rate, right? So as a buyer, you still are kind of gambling there, right? So I think this is where the perception of where market rates are going, interest rates are going. If you don't think rates are coming down, that doesn't sound like as good of a deal if you think you're going to be refinancing in year 3, right? So like that's point one. Point two, the thing that does give me some caution as well, and we talk about this a lot internally with our team, the way that those builders are giving those buy downs is they're paying it out of their margins, right? So the thing you need to be watching right now in terms of how sustainable this equilibrium of them paying for buy downs is looking at builder margins, and margins are compressing. You look at Lennar with their latest earnings report. They got dinged big time because they're guiding down on their margins for Q1. Now, not all builders are the same. I think KB Homes had a much more sort of rosy sort of view of the market. For example, they just recently sort of showed earnings. But I do think if we just have gross margins come back to kind of normal levels, then I'd say okay, then we're probably okay, and they can continue to sustain those buy downs. But if we go below historical norms, those 19-20%, then I think the market is in trouble because the builders could start pulling back actual production and saying, time out, not an acceptable level of margin here. And that's where we are cautious. Like, we think we're probably going to grow starts by, 4 or 5% this year. So modest growth, but still positive. But I think there is some downside risk to that if we continue to see mortgage rates at these levels and builders really start seeing some further margin compression.
Dustin, 4 or 5% for 2025, is that mostly like marginally higher single family and a big increase in multifamily, or is it across the board?
It's about the same. We're 4 to 5% for both.
So basically just natural growth.
Yeah, exactly. So I mean, obviously, the South is probably going to be a little bit more challenged, right? There's definitely more of an inventory glut, a lot more completed homes that need to kind of get delivered. But, single family, for the reasons Gregg described, we do think, look, that this is still kind of the path of least resistance in a lot of markets to buying an affordable home. And on the multifamily side, we're kind of probably more on the optimistic side. I think people are talking about the glut of supply coming into the market. But what's also being discussed is 2026, there's no supply coming into the market because of the decline of starts that we're seeing. So the apartment developers and folks in that space know that rents are going to reaccelerate in 2026 and 2027. So if you're building for 2026, 2027, you got to start breaking ground on that now. Now, what's the constraint? The constraint is rates. Interest rates are not allowing these projects to pencil. But if we do get some loosening on the rate side, the multifamily side is going to take off. So just to kind of put a bow on it here, we don't think this 5% 10-year, 7.5% mortgage rates is going to stay. We think we're going to, especially once some of this policy uncertainty surrounding kind of Trump entering office starts to shake off a bit, and also we also just think fundamentally the economy is slowing, population growth is slowing, some of this kind of government spending is going to slow down. That's driving sort of the government side of the equation in GDP. So all that is going to sort of drive a repricing in the 10-year and mortgage rates to some extent. I think that will be the loosening effect, but that might be more of half to 2025 story than the first half of the year. That's kind of our view.
My thing as a buyer, if I'm buying a new home, I need to know that in year 3, when that thing resets, I can afford it in year 3, not 1 and 2, right? So the whole thing comes back to affordability again. From what I can see, some of these big production builders are still building inventory right now and have inventory they got to clear. And when it doesn't clear through the 3-2-1 mortgage buy down, how many of them are coming in and just cutting 50 to 100 grand off the price of a house to clear inventory, right? Because they all have to. Yeah. So that's what I feel could be coming.
And there's varying degrees here. You can buy, if you want to buy a D.R. Horton home in certain markets in Mississippi between now and April, it's a 3.5% fixed 30-year mortgage.
I'd rather have 100 grand. I'd rather have 100 grand off.
That's what they're offering. And so it's all depends, it's like real estate. It's location. Yeah. Every market is different. There's anything from 3.5%, 30 years to your point, Dustin, to 3-2-1s to combinations in there. Charles, I know you wanted to ask a compelling question, and I am on the edge of my seat. I got to hear it.
Well, I appreciate you standing up for me in this room full of bullies, Gregg. Thank you.
Well, you know what? I'm a wolf here.
I appreciate it. Well,
I know
here's
you're
my
a delicate flower. That's what it is.
So. Very, you called it, my friend. You called it. So 2 things to kind of note that I think about with these buy downs and some of these mortgage programs that, D.R. Horton is underwriting that and probably holding on to the paper. That's how they're able to do that because they're set, right. But, when you start looking at these 3-2-1 programs and these various options, there's still a scenario to where it might be more beneficial for them to rent. But one thing that I've seen in some of the data that I follow in multifamily, there was just a big $60 million deal in Dallas just got bought back by the creditor. Are defaults in multifamily going to be a big deal to where these guys are going to buy them at deals, reset rents, it positively cash flows, and they don't have to build anything? That's the next question. And to top it off, we talk about interest rates, but if you think about agency money, Freddie and Fannie, right? How many of these big apartment buildings over the past 2 years, while interest rates for the everyday consumer at 6.75 to 7.75, right? Were they paying over 6.25? They weren't paying those kind of interest rates on agency money, and they still weren't getting deals to pencil. So what is a real outlook considering those variables? And all of those things impact multiple facets of our economy, not just GDP or lumber or whatever. But even with the 3-2-1 scenario, okay, we'll say that family wants to buy a house, but they really need to buy a new minivan for the 3 kids that they have. Well, they're going to go buy a minivan and go move into an apartment.
Yeah. No question. The data, across almost all markets and all metro areas, suggests the cheaper option financially is renting right now. So there's no question, Charles, that is a headwind for the single family side of the market. And you're seeing it. You're seeing it both in the resale market, in the existing home sales, and you're seeing it to some extent in new home sales, although, new home sales have been more resilient for all the reasons we've talked about. So, no question that is a real headwind out in the market. I personally, I probably don't have the answers for, some of the questions or the questions you raise on the agency money. I guess my kind of high level macro answer when I think about this is sure, right now there's kind of either a liquidity problem or there's a short-term problem in multifamily right now, right? Where everyone recognizes that stuff isn't penciling out. Deals are running out of runway, whatever their financing arrangements are, right? And having to kind of, mark to market their loans at the prevailing rates, right? And that's creating stress. So no question, there's probably some, stuff that's going to fall by the wayside as a result of that. But I go back to the 2026, 2027 story for multifamily is pretty bullish right now, right? So I think if that's your expectation.
I agree with that. I agree with that 110%. I'm just thinking, I'm thinking short term, right? So we start talking about having to break ground now for 26 appreciation and rent rolls, right? Well, if I can go buy something that cost me $72 million to build for 57, why would I not just go buy a bunch of $57 million deals?
Absolutely. I think in the Sun Belt, there's probably a lot of those opportunities that if you're a big real estate REIT or, you're an investor and you have these, this kind of this decision tree, there's probably opportunities out there where we'll say, we're not going to build this, just take an existing asset. And we know rents are going to go up 5% in 2026, and this thing is going to resolve itself. So you're right. There's going to be cases like that out there. No question. That could weigh on the multifamily outlook.
I have a question for Gregg and Ashley. This is somewhat related to what we're doing, but you got Bill Ackman on Twitter/X talking about Fannie and Freddie going public. Private, yeah. Public. And I don't really understand the ramifications of that, but do you have any thoughts on this? I mean, should we get somebody with some real expertise to come and talk about it? Because I think
it's a great idea.
I
think it's a great idea because then we're not publicly underwriting that risk. That is for a private investor to underwrite. And I think Ares Management just raised like a $35 billion private credit fund. So yeah, that would be fantastic. And there's a huge push for private credit because banks have gone small to medium-sized business unfriendly. So private credit in general and a move like that would be monumental for the DOGE effort or Doge or what did Westbury call it with Elon Musk? I mean, it's just less stuff that we have to put on our balance sheet and risk that we have. Yeah, less risk that we have as a country.
I'm just going to say, part of what led to the financial crisis was the whole quasi-government guarantee of Fannie and Freddie and the political pushes on loosening lending standards that was all part of the run up to that. So privatizing it will take away will take away the risk because they're going to be more accurately assessing what they are.
But would it really though? This is what I was going to jump in as and say the horse is kind of out of the barn with this, right? The government's already stepped in and made them quasi government agencies, right?
Right.
So I mean, if they've done it once, why wouldn't they do it again if we had another housing crisis, right? I mean, to me, that's the question I have. Is I'm not sure it really solves anything. I think there's probably still going to be a presumption in the market that hey, if things go bad, the government is going to step in and backstop because they're not going to let the entire U.S. mortgage market collapse. So
it's kind of like the stock market is. It's like we have like a Fed put is we never really have to worry about a big sell off because we know the Fed will cut rates to zero and save everything. Is that what you're saying?
I mean, to some extent, I think if it had never happened, then I think it would be. I mean, it's obviously counterfactual, right? But I just think, if it's already happened, what would make us think that now we've had our medicine and it's, the government's never going to step back in again and make that move, right? So I just don't know that it really solves I don't know if it solves those moral hazard risks you're talking about, right? It's already happened once. It's the same thing with sort of backstopping banks, right? Like once the government steps in and says like, okay, time out, there's no more downside risk here. The market kind of knows that and is implicitly pricing that. I think personally. So
when we get into a subject that I don't completely comprehend, I become curious, and so this is something that I'm curious about right now because I don't really understand the pros and cons of it. I'd like somebody to treat me like I'm in third grade and explain it to me in a dumbed down way.
You want the Labrador treatment?
I do. I'm a little puppy just looking for some fun, but I that kind of stuff is fascinating to me because it could have a broader impact on what we do for a living, right?
Yeah.
And so if you're a professional in our business, you should try to be not just focused on your day-to-day trading, but also realize there's a much bigger world going on around us that impacts whether you're going to make money in the second quarter or not, right? Or what kind of opportunities you might have in the future. I'm looking at this year and I've heard other people talk exactly the same way as Dustin just painted the picture. Like the first 6 months of the year, kind of, nothing real exciting happened on. Then the second half of the year, things get a little bit more interesting, which is kind of the opposite of how we were predicting last year. Remember, we thought all the fun stuff would be in the first half of the year, and then the second half of the year would be like the boring part. Turned out that wasn't the case. The second half of the year last year was a little bit more exciting than we all bargained on. So, just because there's 5 smart guys sitting here talking doesn't mean that we've got it all figured out by any means. And the world does throw curveballs at us from time to time. And so we have to always be curious.
Well, and my thing, Matt, is like I look at, I like to think I thank you for the nice, the nice compliment calling me a smart guy, because I feel really dumb right now because I'm as confused as I ever am about the market. And there's I due to the policy changes that are coming down the pike starting on Monday, which you have an idea of some of them, what they might be, but you really don't know the full extent of a lot of the policy changes. But we're going to have more policy change in the next 100 days than we probably had in the last 100 years in terms of 180-degree changes in policy. And some of those are going to cause short-term pain, which we don't even know what it looks like yet. The unintended consequences of seismic shifts in policy, they're hard to figure out. They're hard to figure out for smart guys, and even harder for me.
Hold on a second. I got to take another bong hit here so I can keep track of everything that's going on.
Hey, you know what? Just stick with the gummies, Ashley. You're safer. It's easier to control your dosage.
Agree, but
gummies throw me for a loop. I used to take them and try to go to sleep, man.
Just one thing to add.
Horrible dreams. Horrible.
Greg.
Well, Charles, I don't want you greening out on me. I thought I saw you in Vancouver like that.
No, definitely not. No, no.
And then Greg, Matt, Charles, let's add on top of that. I mean, Matt, just not to talk about, privatizing stuff. I think that we're going to be pretty amazed over the next few years what the financial technology or the fintech software does to lending and in all that. Just some of these, online banks and everything, things are going to be tracked a lot better. I think that's going to be.
That leads to another question, Ash, for Dustin. How does the growth in AI and the modern computing power going to impact your business going forward? I would imagine it's going to be helpful for you guys.
Oh my gosh. Yeah. I mean, probably not something I have fully wrapped my head around personally, but I mean, I would say it's going to be a tremendous tool, right? Like in terms of basic research or computing power, it's certainly going to augment, like in a positive way, what we can do, right? Like it's hard to envision, right? Because it's sort of like, again, and I've heard some similar podcasts and people talk about this. It really does feel like the late 90s with the advent of the internet, right? Like everyone knows this thing's going to be important, but I don't think anybody has fully figured out like how to efficiently incorporate this technology to, drive this mass productivity boom that is probably going to happen, right? So like, it seems like it's going to happen, but incorporating this stuff into workflows, like I think is like a big thing that everyone is trying to figure out, but it's going to be massively disruptive because it's just for someone like myself who does a lot of desk work, obviously I call around and talk to people in the market, but I'm also spending a lot of time crunching numbers, reading reports, trying to digest stuff quickly. This is a tool that, can really help, especially kind of the chat GPTs of the world. They can do a lot of the work for you. But I will say right now, I mean, clearly when you use some of this stuff, and then someone made this analogy, like, the chat GPTs of the world, they kind of can quickly aggregate information from the web that like probably the average person could do, right? But but very quickly, like a fraction of the time. But because of that, it also still makes mistakes that the average person would do. So like, it's a good starting point to collect information, but you really have to dig into it, and you can't assume that what it spits out at you is correct, because a lot of times it will spit out. It won't spit out the correct thing. It'll spit out the thing that is the most commonly searched for or most commonly viewed or something like that, right? So it's a good baseline to collect information quickly, and I'm sure it's going to get heaps better over the next 5 to 10 years, like from an information collection standpoint. But it's got a long way to go still. But I also think about just things like processing text, getting like information and summaries spit out in seconds. Like, I mean, that's going to save hours and hours and hours of work for someone like me who tries to force through this stuff, right? So it's going to be pretty amazing, and I'm sure there's applications that are beyond my comprehension that are being looked at with this stuff. So,
Yeah, you can call up Grok and go, hey, should I take this short for July?
Well, no, you can dump spreadsheets. So I got both. I use ChatGPT. I pay for it, and I use the Grok, and you could actually start dumping spreadsheets into them now, right?
Yeah,
And I have done that. I've dumped like freight spreadsheets in and asked them to find the discrepancies of lanes, right? But like Dustin said too, is it can do certain things, but what I'm noticing is you got to find all different modules that are for sale at other places. There's thousands of them that will actually let the one thing do what you want it to do, and those are hard to learn also. So there's a lot of stuff out there.
Yeah.
Question market-wise, lumber. Let's kind of bring this back in, and let's bring this whole tariff conversation up for everybody that is talking about this. What's the timeline? How does this play out if something does or doesn't happen? Like, my thought is we won't know anything for 2 or 3 months, but maybe I'm wrong on that. Maybe something will happen right away. Am I wrong? What should we look for? And what's the cadence going to be on this?
I think it's anybody's bet, if I'm being honest. Anybody's bet.
I heard it takes a couple 3 months for it to get published and become certified as an actual United States policy. So there's going to be a lag time, and in the short term, you'll have to deal with same old thing you always have to deal with as a mill: empty cars and production and weather, and whether the customer actually wants to buy lumber this week or not. But in the long run, that cost will get either absorbed by the producers or passed on to the customers, or some combination thereof. We've been through all these changes in our careers, right? We went through the tariffs, we went through the quotas, we've gone through any number of different, I don't know how you want to call it, realities in the lumber business of how lumber is going to come across the border from Canada to the United States. And the current one that we're in was negotiated 10 years ago, 12 years ago. So if a new one takes its place, we'll just move on forward. There'll be some disruption in the short term, and then the long term, the price of lumber will find water and it'll level out.
Yeah, I mean, the way we're thinking about this, I mean, we're still, our kind of house view right now at Fastmarkets, we still feel like these tariff threats are probably more negotiation than reality. But I've got to say, the last week or so, just looking at just kind of the evidence out there, I think the tail risk that we do have, at least a short period of tariffs being enacted in a broad sense, not just Canada, but across all goods. I think the risk is rising of that. I don't think it should be your baseline, but I think you have to price that in. And I think, part of the reason we think it could be a reality are twofold. One, I mean, it's obvious that there's a negotiating position with the incoming Trump administration's trying to take with bilateral negotiations with different countries, including Canada, right, which is the most relevant for our purposes. But Europe, too, could be affected, Euro spruce, all that. But where I find it's conflicting, when you look at what's happening at the congressional level, they want to pass a big tax cut, right? And part of the way they want to fund those tax cuts is through tariffs. And when you look at the people being appointed to the Trump administration, so Secretary of the Treasury, Scott Bessent, is head of the Council of Economic Advisors, they're on board with the tariff proposal. So you can't have both. You can't have this is going to be a negotiation lever, and when we negotiate this, we're going to drop the tariffs and legislate tariffs to pay for tax cuts and spending increases, whatever they may be, right? So that's where, when I look at it, say, geez, I don't really know what to think of it. I think we're going to have to wait a few weeks to see how this plays out. Right now, as I said, the kind of the rates and demand picture are trumping, again, no pun intended, the tariffs side of things. But I do think that risk is real, and that tail risk you have to be thinking about. So
I'm on record of saying there's a greater chance of us taking control of Greenland than there being a 25% tariff on Canadian lumber. Now that having been said, I've moved to this place that, if there is, that's probably pretty good for our position short term in terms of increasing the value of all of our inventory. But long term, it's probably a big negative. What I do know is that duties on Canadian lumber will be going up to 30% in August. That's, 5.5 months from now. So if I'm a Canadian producer, I'm just thinking, I'm like, oh, wow, no matter what happens, I've got that bogey out there right now. What am I going to do about production, am I going to try and make more lumber, or am I going to try and make less lumber?
I think, and this is, you're right. Like the situation for Canadian mills, it's either very, very bad or horrible. Like, like it's going to go from bad to very bad, or however you want to phrase it. Right. So you're right. I mean, we don't know exactly what the duties are going to go to. We think they probably will double. That's our view as well. Just looking at, retroactively how the Department of Commerce does this. And then obviously if you've got a stacked 25% duty on top, 25% tariff on top of that, 50 to 60% to come into the U.S. market. I mean, obviously no Canadian mill, that's not tenable, right? So the only result is, the way I think of this, right? And I heard you guys talk about this a little bit on your last show too. I think right now, downstream in the market, I don't think there's a ton of inventory, at the distribution and retail level. So, the Canadian mills come off the market because no one can pay 50% coming into the market by mid-year, or let's call it 30%, 40%, if it's existing duties plus the tariffs come in January. Canadian production comes offline, prices rise, U.S. operating rates probably rise, but the Canadian production probably comes back online too in response, if we get to 600, 700 per thousand. And then I could see prices completely nosediving when we get that sort of lagged supply response, right? So I personally, I just think it's a recipe for volatility in the market. I think volatility is going to be a lot higher than it was in 2023, 2024 because of, and Matt mentioned this, you guys have lived through this to some extent, right? But there still is a little bit of a wild card element here of how this will play out. And I don't think the inventory situation downstream is particularly, I don't think there's a ton of inventory at the retail level, at the sort of yard level, right? So I can see this driving some volatility in the market. Just given the big swings, it's you're going from 15% to 30, 40%, in a short period of time, and a lot of capacity that's going to be sort of offsides. Just as a reference point, we think for the BC interior and also, the Quebec producers, their US dollar variable costs are probably around 375 to 400 per thousand without duties or tariffs right now. So if you use that as your baseline, prices have to go pretty high up with a lot of duties to pull them back in the market, right? So that's how I sort of think of it, in terms of how this has to play out to keep that supply in the market. Because again, 25% of lumber consumption in the U.S. comes from Canada. Some of that can be filled by the U.S. by higher operating rates, but not all.
Well, what about structural changes in using SPFS? More widely adopted use of SPFS, I should say.
I mean,
it doesn't have the strength.
Then I guess we're going to Southern Yellow Pine, to the moon, boys, to the moon.
I mean, there's a heck of a lot of Southern Yellow Pine.
The reality is that's a place to be positioned. I mean, that's the future.
I got an observation. You guys notice that Charles looks like Fidel Castro in his prime?
I thought I was a whale last week.
You look just like him.
I'm a communist.
Which leads me to my next question, Dustin. So did Trudeau resign, or is he still the PM? I mean, how does that work up there in the Great White North? I don't get it.
Well, I know I've got the French Canadian last name, but I am an American citizen. Okay, so
okay,
but
I thought you worked for a Canadian company. I'm sorry.
Yeah, no, it's all good. No, but I think he's still prime minister, right? It's not like
elections are in March.
Yeah.
Okay, so they did call for new elections then. Okay.
Yeah, he resigned.
But I mean,
in March.
I think the important implication of that though really is okay, he's still prime minister, but it really puts Canada's bargaining position with this whole tariff threat right from bad to worse, right? You have a lame duck leader now that can't really legitimately negotiate when if and when Trump comes to the table on this whole tariffs threat, right? So I mean, and when you look at just and I don't follow this at a super detailed level, but just my understanding, the different premiers of the different provinces are fighting about the approaches they want to take, and they have different interests. Alberta has different interests than Ontario, has different interests than Quebec, and again, the provinces have a lot of power as well. They're kind of, it's a lot different than the U.S. where the states, they don't have a commerce clause where they can't kind of have trade barriers against each other, right? So it's a whole different dynamic up there And even though he's still technically in power, it puts him in a really tough spot from a negotiation standpoint. That also is a reason I do wonder if that raises the risk of kind of an accident where Canada isn't organized enough to come to the table. Tariffs are put on by the U.S. and we have, a few months or something like that where stuff coming across the border is taxed at, an extra 25%. So again, that just sets up a volatile sort of environment. And then just to add to that, if you know that there's a negotiation and the tariffs are likely going to be lifted, okay, then that's going to drive destocking in the market, right? People are going to say, well, I'm not going to buy. I'm going to wait till the cheaper lumber comes without the 25% tariff, right? So, I mean, you could just see a lot of bouncing around in terms of the inventory cycle here the next few months. But there's just a million ways it could play out. So that's the timing of it, and how prolonged it will be is a big question. But that's a big implication. He's a lame duck prime minister, and that just makes it even harder for them to come into a bargaining scenario. So,
Dustin, and then we'll wrap it up. Euro wood coming in. Will that have a tariff on it?
I think you guys mentioned this in your last episode. I was listening along. I think if you're thinking that tariffs I don't think we're going to have prolonged tariffs. I think this is probably more likely a bargaining, position than something longer term. I just think there's just too much downside to the economy and the stock market if it gets put in place, and the incoming administration is not going to want that. So, but if you do think that there is a tariff scenario that is sustained, I think it's more likely that it's sustained on European goods than Canadian and Mexican goods, where we have an existing trade agreement through NAFTA, USMCA. So I think the odds of it are probably higher that a prolonged tariff or duty is put in place on Euro spruce than a sustained stacked tariff for Canadian lumber. But I still think the odds are small. I still, in both cases.
And then lastly, I've been having fun messing around on the thing. Why should people, and give us a little bit quick bullet points, random lengths dashboard. Why should people be aware of that, and why should they sign up and use it, and how do they do that?
When you say the random lengths dashboard, we've got the Metro dashboard, and then we've got our new our sort of Fastmarkets dashboard.
Yeah, I'm not a Metro guy. I'm more of the Fastmarkets.
Okay.
Yeah.
Okay. Fair enough. Our dashboard, if you're a Fastmarket subscriber, we're rolling into our random length subscribers and our other forest product subscribers are being sort of onboarded into this new dashboard where you can basically create a customized sort of viewing platform to look at prices, to look at market data, all that. You can really customize a news feed. All those things are kind of cool applications. If you have different dimensions or different items that you care about, you can create a bunch of different preset charts. You can look at the futures prices as well, looking out, on the futures curve as well. So there's a lot of great data on the platform. If there are folks who are signed up for it, who are starting to use it, that need some help, feel free to reach out to me or reach out to your customer service person. We want to get people onboarded with that. But it's a great tool, and they're continuing to add features to it. So I'd really encourage folks to reach out if they have any questions about it. So.
Appreciate it, Dustin. And boys, I think we've kind of gone over the overvalued, undervalued stuff. Unless anybody's got anything they want to go up to put some bookends on this.
No, I think this has been a great show. Awesome, Dustin. Always good to have you on. I mean, we need to have you on more regularly. If you'd put up with us, I think that's great.
Yeah.
No. Thanks for having me. And I just want to say too, I forgot to mention at the beginning, congratulations on your 100th episode, guys. I know I'm a few episodes late here, but you guys do a great service for the industry. I love the content you guys put together. You guys have tremendous insight. So again, congratulations and great work. So
that's why we're going to have him back again.
That's why we're having him back, right? Yes.
When you stroke us like that, then you really get to come back. Yeah.
I think the overall undertone, and as Dustin likes to put a bow on it, nobody has any idea what's going to happen. Just transact business until something happens. That's
we're all going to have to be reactionary.
There's no way to prepare for this. There's too many unknowns.
Mm-hmm. All right, guys. Hey, listen, great week. Thank you.
Thanks, guys.
Thanks, Dustin.
Adios.
Thanks, guys. Good to see you.
Thanks for listening to this week's episode of The Lumber Word. The Lumber Word podcast is dedicated to engaging conversations about the lumber industry, including trading ideas, market trends, and evaluations of overvalued and undervalued assets. We wish to emphasize that the discussions and opinions expressed in this podcast are purely for informational and entertainment purposes. They should not be considered as financial or investment advice. We encourage our listeners to make their own financial decisions, taking into account their unique circumstances and financial goals, and to seek professional financial advice if necessary.